We are less than 6 months away from the presidential election. And if you're dreading the potential turbulence from that and you worry it'll spill over to the markets and think, maybe I should park my money in cash, our countdown closer says, no, hold on. He points out that since the S&P was created back in 1923, it has returned on average at least 11.3% annually, regardless of whether there was a presidential election year. David Kudla manages $4 billion. He's the founder and CEO of Mainstay Capital Management. That I thought was a really interesting point. And also, don't vote your politics. If a president gets elected whom you don't like, don't pull your money out of the market. That was a mistake if you didn't like Trump, and that was a mistake if you didn't like President Obama.
Yeah, Liz, it is incredible, our clients and many of the people we talk to, how much their politics will tend to influence their investment strategy or what they want to do with their investments. And as you said, the number one rule is don't go to cash. It's rarely been a good idea to be on the sidelines, but there are polarizing events. There are presidential campaigns that point out the negatives in the economy and other aspects of what people consider in their investment strategy. But what we found is election years are quite good compared to years on average. And it makes sense to stay invested. Don't go to cash. We know we're going to get those calls. Don't go to cash, to wait to see what happens, because it makes very little difference over the long run.
Which you just pointed out with that 11.3% annual gain. And that's a Buffett thing. He says just park it in the S&P long term. Okay, David, in this election year, again, we know that it really doesn't matter, but are there sectors that you believe have a power to run ahead of others?
Well, it's interesting. If we look at historically what sectors have done poorly, what sectors have done well, energy, communications tend to do well in election years. A lot of times there's talk about what will happen with drilling, things like that affect oil prices, which drives energy up. On the flip side of that, the healthcare industry, there will be talk about bringing healthcare costs down or the price of drugs for seniors down. That tends to hurt the healthcare industry. If we just look at this year, XLE is up about 12%, beating the S&P 500. And the healthcare sector is only up about 5%. So we're following that trend. There are other factors in there, obviously, but we're following that trend. We want to be careful not to mix causation with correlation. But it is important. What we do know, though, you've talked on the show a lot about generative AI and its impact on the economy and really what will become another industrial revolution. Sectors like that will power right through the election. Politics don't matter because that is a secular growth trend that's going to have legs for a very, very long time and will have very little to do with what happens in any election or politics in general.
One thing for sure, the Fed often has something to do with the way the market moves, certainly in short-term spurts. Next week, we get the CPI. In fact, a week from today, the next fresh read on consumer inflation. What are you looking for there? And what do you think the Fed is going to do when it comes to cutting rates this year?
Well, we've been in the camp. We've talked about a soft landing, a hard landing, and no landing. And we've been in the no landing camp for a while. And what we mean by that is we'll see this slow down, but then we'll see the economy accelerate again. Right now, the Atlanta Fed GDP now forecast is quite high. We're at about 4.9% estimated GDP for the second quarter. So GDP has remained robust. Inflation, we're yet to see if the disinflationary forces will be enough to bring down inflation with what the Fed is doing. The Fed, we don't think will raise rates again. They're looking for a reason to lower rates. But, the 6 or 7 rates that we look for at the beginning of the year, not going to happen.
Yeah, that's in the rearview mirror. No way. Thank you very much, David Kudla.